Good morning. Welcome to the Brew, the Wednesday edition. Today, we are going to tear apart Apple's earnings. So let's get right into it. We have a lot to talk about today on Apple. Molly, you're looking down.
My voice. Am I?
Oh, you were almost frozen there. I think you have a Halloween hangover.
I do.
Okay.
So we've got a really cool. We're gonna take a bite out of the apple today.
Ooh, I like that. A bite out of the apple. So I kind of looked at some of the the earnings estimates. We'll show that in a second. I got to be honest. I'm not super directional on these things. I don't know if you have a kind of directional bias here. But we're gonna set something up without directional bias today.
Okay, I love that.
Just to see how that plays out. Okay.
My little CT scan would say that, especially with Meta, I noticed, and especially with some Tesla stuff going on, you can see the fundamentals are really strong, and then there's a dip right after earnings. So is that the big guys trying to put things on discount? I don't know.
Yeah, I'm with you, man. I'll tell you what, these companies, these tech companies have been heavy. They have been it's been a tough slog lately. By the way, look at the size of my water bottle. Holy cow.
You're hydrating.
Delicious. What were you for Halloween, by the way?
I was a researcher for Halloween.
Thank God you did something different. Way to go. All right. Shall we get into it?
Yes, let's
go. Do it. All right, let's go to the screen here. Let's see what we got. We are gonna share. All right. Ooh, this is very dark and Halloween, isn't it?
Ooh, spooky.
All right, let's see what we got. Fast. So the estimates. Here's the breakdown. So they're gonna report third quarter earnings, right, on November 2nd, which is tomorrow, after the market close. Okay. Quite honestly, I had an interesting situation happen to me when I was in the trading business. We had earnings in Google after the close, except they came out about 50 seconds early before the bell. Ooh. That turned into a catastrophe. That might be another show. But anyway, when people say after the close, I really hope it's truly after the close, because you just get rung up otherwise. Anyhow.
I'm sure there's ambulance and like cuts and
it's bad. Yeah, you get shredded.
I want that show. I want to know that story.
Yeah, I'll tell you that story on another show. So analysts are expecting an EPS, earnings per share, of $1.39 on revenue of $89.37 billion. Wrap your head around $89 billion in one quarter.
Yeah, I know. They're doing a 12. Yes, I know. It's just massive. And what was surprising when I looked at this was that one of their bulkiest thing is their services. It's getting double-digit growth.
Yep.
Almost every quarter.
Yep, so it's insane. So actually, though, the earnings per share is a 6.4% decline. But the revenue is an increase. That quarterly revenue is an increase of about 6%, 5.9%. So interesting, a little bit earnings per share decline and a little bit of revenue increase. I think I'd rather have the revenue if that were me. I'd rather have more money.
I know there was a price target for Apple cut by Oppenheimer from 220 to down to 200. So that's interesting. But I think people are majority positive. But then look, this is like the normal news you hear. It's up, it's down. We don't know. So It's really you're doing a non-directional position today.
Yeah, that's what I'm going to do. I'm going to show it to you in a second. Let's get one more slide here. So here are the factors that impact these earnings this quarter, right? Obviously, iPhone sales is number one for them. The 15 just came out. It's clearly Apple's most important product, right? They're expecting sales of around 45 million units, okay, which is just a slight increase over last year. But that's, again, it's unfathomable how much that is, right?
And they have a bit of a challenge in China. So they're having Yahweh. How do you pronounce that? Huawei.
Yeah, that one. In
That one.
China. Yeah.
So they are, when we've had sanctions against China, they couldn't get their supplies. And so they dropped from number 1 in China down to number 6, making Apple first. But now apparently China's reporting that they're back to number 1. And it's still rough producing that iPhone in China. So there's a little bit of China concern there.
Okay, so a little China concerned. All right, got it. Service revenue, you brought this up earlier. This is important because it's expected to be $19 billion this quarter. Just the service revenue. That's a 10% increase over last year. That's massive. You know, you just can't imagine. I never imagined how important service was to them. I mean, my iPhone never breaks. I don't even know why anyone needs service. Right? So unless I drop it.
Right. That's like Apple TV, music, books, podcasts, you name it. I mean, they've got the iCloud storage. So there's a lot of buckets there dipping their feet in.
Yeah. By the way, I just noticed you're in a new location. You're like kind of got a new thing going on. There's like a light behind you. You're illuminated. I feel like you're coming to me from like outer space or something.
Halo. Right.
Okay, Miss Halo.
We're on a bit of a surf trip. We're at the beach. So I'm working though, I promise.
Sure you are. All right. Number 3, Mac and iPad sales. Expected to be flat, but Mac sales are around 6 million units, iPad around 9 million units. I don't have a flavor for this. Yeah. First of all, I have a Mac. I'm using it right now. I don't have an iPad, but nothing negative to say. I like them, I guess. I mean, how can you replace the remarkable? But I like them both. So that's interesting. Probably third on the list. And lastly, the things that impact these earnings are the supply chain constraints. Still facing some headwinds from COVID and the war in Ukraine. So look at, if they can't get the stuff they need, obvious it's going to impact the output. So
and there's also concern for strong dollar, that people are having a hard time buying their products outside of the US. But man, that M3 chip that just came out, you got to just hear this thing. 3 nanometer manufacturing technology, and there's like 8 main cores, which is like the engines of the chip, and then 10 cores for the graphic cards. I mean, this thing is like nuts. And you say you're a PC guy, I'm an Apple guy, and that points to the instruction set architecture. Mm-hmm. So when they build these new chips, we've got to look at ARM, because Apple is one of the main investors for ARM. They've been with each other forever, and so they're running everything off. But some interesting news is that they're not wanting their eggs all in one basket, so they're looking at this RISC-V. So take a look at that, do your side homework, but they're going to have another go-to outside of ARM, which will be interesting to watch to see what happens.
Okay. I love it. So with all this information,
yes, give it to us.
What do we do? What do we do as traders in the community, right? Here's what we're going to do. Are you ready for this?
I'm ready. Wait. I've gotta, what is it?
Uh-oh. Are you going to do a theta harvest on me?
Yes, I'm theta harvesting my tea here.
All right, to the remarkable we go. Can you see this? Yes, we can see this. So we already said November 2nd after the close. We know that to be true. Okay. So there's no rush here. Hey, how come I'm not working here? I got it. There's no rush today. No, today's the 1st, right, Ma?
Today's the 1st.
There is a rush. Now, actually, we have it till tomorrow because it's after the close.
Yeah.
So I would probably wait till tomorrow. So first thing we kind of decipher, are we directional? Meaning, we as a trader, do we have a bias? Do we believe in the upside? Do we believe in the downside? Okay. I can't tell you that right now. I don't know. These estimates look great. It's a matter of whether or not they make them. I think they're going to make them. I think it's going to be positive, but I'm going to say that I'm non-directional. So, I don't care up or down. It could go either way. So I'm going to go, I don't know.
I don't know. I got slammed on the meta. So I will say that Qualcomm just announced that they came out with a processor saying it's faster than the M2. So we'll see about the M3. And then we've got a little bit of competition, and there's concern with, the economy with like you say, with what's going on with Israel and Ukraine. So
Yep.
I don't know. I'm non-directional today.
Okay, good. Well, this is going to work for us. Number 3, let's figure out the expected move of Apple based on the implied volatility in the marketplace. Now, we'll look at that in a second when we go to TradeHawk. But I have already done that analysis, and what I get is about $7 plus or minus. Okay. And the way we typically look at that for the folks and the retail traders is we take that month that has the earnings in it, which happens to be the nearest month, I should say, which happens to be this I think it's a weekly, if I'm not mistaken. So it's expires this Friday. Okay. That implied volatility is really, really high. And the next one after it is relatively low. So there's a big disparity there. Okay. So we take the expected move based on the straddle of the month that hits earnings first, the nearest month. Okay. Now I computed it to be roughly $7, and I'll show you how to do that on TradeHawk when we get there. But you take that $7 straddle and you subtract it from the at the money, where the stock's currently trading, and then you add it to the at the money. Okay. Those are the kick points of where the marketplace is expecting Apple to go. Now, is there a rule that says it has to do that? Of course not. We are trying to be statistically advantageous in our trade and put, the edge in our favor, right? Okay. So the marketplace is smart. They know these things. So they're expecting that move up or down to be about $7. So we like to place our short option on one of those 2 points, or both in the case of a non-directional, which we'll see in a sec. Okay. So in that case, we're looking at strikes of around 163 on the downside. Apple's roughly trading 170-ish. And then we'll call it 177 on the upside. So having those 2 strikes, we're going to place a short at each one of those points.
Okay.
Now we need protection. We can't have just a strangle. I mean, we could if we had a ton of money in our account, but that's not smart. We like to look at risk-defined strategies, things that have a defined reward and a defined risk, nothing undefined. Okay. With me?
With you. And then if you're just new to trading and you're trying to figure out what your parameters are, follow a pro. So follow Lex. So write this stuff down, screenshot that remarkable, because this is good stuff.
Yeah, this is important. Now, the implied volatility, IV stands for implied volatility, for anyone who didn't get that. It's an industry standard, IV. So in the month in question, the front month, it's 65 implied volatility. Okay. 65 means that on an annualized basis, it'll move 65% up and down, up or down, I should say. Okay. The second month in question is only 35. Apple historically, implied volatility historically is probably in the, give or take the 25 implied volatility range. So even the second month's a little high. 35 is much higher than 25, but 65 is really, really high. So the difference between these two gives us enough of an interesting opportunity to do a time spread or a calendar spread. Okay. So we sell the high volatility, we buy the low volatility. Okay. We've got a defined risk, a defined reward, and we're going to look at a graph in a second of what that looks like. Okay.
I love that.
And it's cheap. It's cheap. It's not expensive. It's about $1. So that's not too much. If you pay $1 and and the max profit here is around $6, that's a pretty good reward to risk ratio.
That's a nice margin. Yeah.
Yeah. It's not bad. So we look at those reward to risk ratios. Okay. And we're trying to get 2.5, 3 or better. Right. And the way I do it is I take reward, my max reward, right, divided by risk, comes up to some ratio. And we want that to be greater than, roughly 2.5. I like to get 3 though, to be honest. Now, the other part of reward to risk is you could multiply by the probability of profit and the probability of loss on each of these to get a more granular number, which is a better way to do things. Okay. We're going to do that on a separate show because that's a little involved. But for now, I discovered that I think my risk ratio, reward to risk ratio, is around 2.5%, 3%. But let's take a look at it. Okay.
And
So
then just quick question. I don't know if this is probably a bad question, but if you're talking about investments and, let's say someone's a little younger and they can play around, or someone's a little bit older and they have to be a bit safer, can you bring in implied volatility? And if so, which percentage are you looking for? And is that 3 still hold for any age?
Wait, I'm not sure I understand the question. What do you mean bring in implied volatility? Sorry.
So, you're saying 65% is high implied volatility. If, over a year, it can move up and down that much. So it seems riskier than something lower. So if you're someone, let's say you're in a demographic that has to be safer,
Mm-hmm.
what percentage are you looking for in implied volatility?
Oh, here's what I like. That's a good question, by the way. I like to look at implied volatility ranking.
Ooh,
Okay. And
okay.
all that is a measure of where current implied volatility is relative to the range of implied volatility over a period of time. And typically we use about a year.
Okay.
So the way that computation is made is you take current implied volatility, and it's a fraction. You take current implied volatility minus the low of the period, okay, as a quantity, divided by the high minus the low of the period. That's going to tell you where your IVR is. Okay. And if you have an IVR rank, and I like to be like 40-ish% or greater,
Yeah.
it's a time to sell premium. It's a good time to sell premium.
Okay.
Below 40% in IVR, I like to get as close to, I can to the bottom, but I'm not a big premium buyer anyway. I need a lot more goose on the downside. So, 20% or less for me to start buying it. And I hardly ever want to buy it.
Okay.
So I like to see that number. IVR in Apple's probably pretty high in that front month. It's well up there. So it makes sense to be doing this. Okay. I changed the parameters. You ready? As we're sitting here, I changed them. I want to make sure I got the right ones before I go to the screen share. You ready for this?
Let's go.
We're going to take a peek at Trade Hawk. Let's do it. Okay, here we go. Where are you? There. Would you look at that? Okay. So this is our trading system at Tradier. It's called Trade Hawk. I use this a lot because there's some really cool features in here, especially when it gets to understanding probabilities, right? So I built this spread. I'm non-directional. It almost sounds like a weird term for something else, but I'm not going to say it. So I'm non-directional. I'm not sure which way it's going to go. So what I've done is I've taken advantage of high volatility. Look at the implied volatility in the November 3rd cycle. Okay. It's 65.54 up here. The next month or the next term is 9 days out, 38. That's huge. So I expect my spread. I'm going to sell the 65 because it's so high. I'm going to buy the 38 because it's so low. I'm going to do the same strikes, but I'm going to do a downside put calendar and an upside call calendar. How am I getting there? I'm taking the straddle, which is the 170. In this case, the at the money, that big orange line. I'm adding about 410 and about 290, let's call it, together, right? Gets to be about $7. That's how I got to 7. I'm going to go down 7, which would be 63, but we don't have one of those. We got 62 and a half, close enough. This isn't brain surgery. And we're going to go up 7, which would be around 77 and a half, but I had a position here, so I'm going to go up another strike, give me a little more range to the upside because I'm a little bit more biased to the upside on this one. So I'm going to use the 80. So as you can see in this front month, I'm selling the 62 and a half put. I'm selling the 80 call. That needs protection. I'm going to the cheap month, okay, buying the same call that I'm selling in the front. So that's the 180. And I'm buying the same put, the 162 and a half in that second month or second expiration, which is the 62 and a half. I'm buying one of those. So this is an even ratio, 1 to 1 to 1 to 1 to 1. Okay. I've got 4 legs. This is a double calendar. Okay. We call it a custom spread in Trade Hawk, but it's actually a double calendar. As I said, it's trading for about $1. So you can see that limit price right now, mid-market, about 97 cents. Let's just call it $1. It's easier math. So that's $1. Okay. Now, when I send this to the risk analyzer, which is the what if, we get this tent graph, our double mountain graph, right? So we want this stock to settle at the peaks. This is down by the 162.5. This is up by the 180. So we're looking for a move either way, right?
Okay.
And if you look at max profit here, it's $266 for every one. So it's about 2.6 times reward to risk. But
okay,
look,
just
yep,
a quick question. So now, are we doing a Batman graph for Halloween? Is that plans?
that could be a bat wing graph. Look at that.
Yeah, is that a Batwing?
Yeah, that's your name.
Okay.
I love it.
You're good. You're good, Lex. Wow.
I planned that, the bat wing. That's pretty good, Mal. So look at this range of where my break evens are. It says 100% that we have 100% chance of falling into this range. Now, clearly, out here I'm not making any money. Down here I'm making very little money, and I want to see peaks. But this is a great risk reward. Look, I have very few places I can lose. How do I lose on this trade? Okay, and I can only lose $1, right? That's my cost. I can lose on a massive move, way below 155 in this case on the chart, and way above. I can't see up there 187.5, way above those 2 points. I lose. I'm going to lose my $1. Okay. I like this reward to risk. I'll take this chance, because anywhere along the way I'm going to make some money. Okay. Now, a lot of people say, great, wonderful, great for letting us know this. How the hell do you get out of this? Well, look, in real terms, you're going to have this trade on, and I'm going to invert it here. Okay. And it's going to be a closing, right? So I'm going to invert it back to the opening. So I'm just going to trade this whole thing out as a spread. Okay. Now, if I pay $1 for something, I'm hoping I sell it for $2 or $3 or some other number, right? So when this opens on, let's see, it's after the close tomorrow. When this opens on Friday, what's going to happen is we're going to realize the move. Okay. It's going to move to its spot. Implied volatility in that front month is going to get crushed. It's going to collapse. The second month's going to come down for sure. So that hurts us. But because of the disparity between the 2 months, we're going to get a bigger crush in the front, hopefully, and a slightly less crush in the back. Okay. And we're going to and that spread's going to widen, we hope, with the news that's already out. Front month comes down. And then all we're going to do is just reverse this out. We're going to take the opposite side of these things and get out, hopefully, for something better than $1. Okay. Now look if we're wrong, okay, you could see a break even. Okay. That's not horrible when you're wrong, right? So let's say this Apple goes up to 175, and I'm just making this up, right? And I think we have to do a different day. Let's see what happens here.
And while you're doing that, I mean, and I'll just say, with the SEC regulation coming down on retail traders, I mean, this looks pretty safe. This looks really safe to me. This doesn't look like
it's very safe.
Need a lot of protection because you do this. And because you got 7 days in between, you're going to have a little life left in the second month. So you even if you're wrong, you'll wiggle out of this. Look at 175 on the day to go with the stock up there. It's $1.50 this spread. I make 50 cents. That's awesome. Up at $1.77. Let's just see what happens there, just for fun. Oh, what the heck did I do here? And this is just such a neat scenario too.
Oh yeah, it's fantastic. Yeah. So 153. So that's pretty good. Okay. And you could play this game, especially on TradeUp with the calculator icon. You can move prices around to see what this spread would be worth tomorrow. Now, what I didn't do, okay, is I didn't lower volatility in these front months, because what's going to happen here is this implied volatility in the front month is going to come down to let's just call it 35, okay? Yeah. Because that's about right. And let's make the second one, is that my short? That's a 35, okay? Now, the back ones are going to be probably around, it's going to be in the 20s. I'm going to say 28. Let's see what we get here. Okay. And this is an exercise that we always perform here too. So you're going to get this kind of volatility mess here. I'm going to go another day to Friday if we can hold it along. I mean, look at what happens as the time wears on. Implied volatility goes back to normal. Our spread's 164 now from $1. So we make 64 cents on that. So this is a very safe way to play the earnings. It's a play I like a lot with disparate implied volatilities when we have a front month that's really bid up because of earnings. Make sure you check that expected move all the time, though. It's super important to see where that plays out. And if you want to buy yourself a little more little more space, that's fine. Try to get a nice reward to risk ratio. So pay as little as you possibly can and take a peek at what this max profit looks like relative to your cost. Okay. We try to get 2.5 to 1 or more. The bigger, the better, right? Make sense?
Makes sense. And so that was really great. And again, rewind, study this move, because you can use it in any earning season for whatever situation you're in, if you're non-directional.
Yep.
I would say, all these great products came out on the 22nd, but they're not going to see it. This is their fiscal year end. So those are going to get pushed out. Pre-orders might have happened, but those are going to get pushed out in the beginning of this next quarter. Tim Cook did visit China on the 17th. And so we'll see how those talks went, and we'll just keep an eye, but we've got some competitors on their tail. So we have Intel coming out with great numbers.
Right.
We have NVIDIA announcing a new processor. Qualcomm made their announcement. So we'll sit and wait on our non-directional position here.
Yeah, I'll keep it up. I'll keep it up here. And maybe we can refer to this in the coming days here. I'll keep an eye on it and see what it did, and let you know. So remember, easily we got in for $1. We're hoping for more than $1 to get out of it. We'll take a peek at it in the days coming up, see what happens. I mean, look at what's even more beautiful about this. If you truly are some sort of analyst and you can pick direction, you don't have to do one side of this, right? You say, I'm just so confident that Apple's going to go higher. You already have your standard deviation roughly. You can use that to the upside and just do one set of these. You can only do the upside if you want. So I just did both ways because I'm non-directional on this one.
And if you are directional, can we call that a broken bat wing?
Or you can call it a broken back. It's just going to be a TP. It's just going to be one of those little middle ones, and a little hump to the upside.
Okay.
A broken bat wing. All right. What do you think, Mal? All good?
That sounds. Thank you, Lex, giving us action on news. What are we going to do with this news? We can actually do something with Lex.
Can you actually get in the water surfing? Are you kidding me?
It's so cold. I have the heat up here to like 90.
It snowed where I am yesterday. We have snow on the ground. Yeah.
I'm a Californian, so I love any weather is great.
Yeah. All right. Very good. Good show, Mal. I will see you soon.
In LA.
I'm coming to LA, right? Friday.
All right.
All right. Be good. We'll talk to you later.
All right. Bye.